Yes, thank you very much, Veronica. It was really, really good. It was so good. And I really appreciated that people actually participated, allowed to just let the guards down. And I really appreciate that. And that's what I want these networking events to be. I want us to understand that, yes, we are very much driven and property people, but at the same time, we're people with soul, with heart, with emotions, with mental health problems, etc. And I want us to be able to speak about it, just tell a little bit. So, you know, you saw, Ashley, that you and me are the same type of people, and it's good. We're not alone, we're not crazy, and we're not weirdos. We are so many weirdo clubs that we just, if we find out each other, we will be able to help each other, we will be able to work around it, and we will just learn from one another. But my next speaker, there are so many brokers in the property world. But this gentleman is a property broker, he's a property mortgage expert, but he does it in such a humane, he puts the human you first. And I don't know, like, I think it's a lot of the time, I more and more often you see that in a property sector, that those people who put people first, they do great in the business. And Philip Game has set up Shire Finance, I don't know, 20 years ago. He has, before that, he worked for PwC. And you know, like when you recommend sometimes some people, some sort of, maybe you are not 100% sure, but when I recommend Philip Game to anyone for, you know, a mortgage or property brokerage, a mortgage brokerage, I feel like 200%. I feel like I know that he, you know, he is going to take care of this person really well, because he's very genuine. He's just, I think what Veronica said, when she said, when your soul is aligned to your personality, I think that what you see at work and at home, I think, is the same, because that's just that alignment of what he does and he loves to do, and he does it really well. So I welcome you. If Philip Game can join me to the stage, that would be really appreciated. He is going to talk about the mortgage market. He's going to talk about, if you have taken holiday payments, what are the consequences of that action, and what's happening after taking those holidays. I've seen a couple of examples how mortgage applicants have been refused. We also have seen some of the situations where bounce back loans have resulted in negative mortgage result. I don't know whether that is a myth or not, but Philip Game will be the right person to talk about that and explain to us what should we do if we have taken mortgage holiday and we are going to apply for mortgage application again. What should we do so that we correct ourselves before applying, so that we are not refused?
Hi, thank you.
Hi.
Well, what an amazing introduction. All unexpected, but very grateful. So let's see if I can live up to your comments. So if I try and get my presentation started, being a mortgage broker and being an accountant before that, so I've got lots of numbers, so it's going to be a completely different presentation to before. So
yes.
If I take myself off, let's share my screen. Yeah, and okay, so hopefully you can see the screen now. So yeah, let's get started. So the agenda, I thought I'd tell you a bit about myself, who I am, introduce myself. Amira's done a great job in telling you a bit about me so far. I'll talk about the current market, where we are and what's happening. Not really knowing who the audience is, I thought I'd come on to first-time landlords and a few things for first-time landlords out there, how easy it is to get mortgages. Then looking at limited companies and some sort of specific things around limited company lending and markets. Self-employed. Lots of people seem to have different views around self-employed people and how they can use their income, what they can use it for, what the banks look for. So cover some of those information. And then a big thing I get asked about is, should I buy in a limited company or personal? And really just I want to work through an example of maybe some of the differences that people don't seem to think about. And I've got a few case studies of properties in Leicester, Liverpool and Newmarket. So to help give some live examples of what we've done, how we've helped people. Somewhere in there, I've also written a bit about how the banks work out how much money you can borrow on your buy-to-let. So I've slipped that in the last sort of half hour today, so it's not in the agenda. So who I am. I started off working for PricewaterhouseCoopers, who some of you may know are sort of one of the world's largest accountancy firms. So I spent 11 years working for them, trained as a certified accountant, didn't actually pass my final exams. I got so fed up with studying by the time, but I was a manager at Pricewaterhouse and we used to run receiverships and liquidations. So I was running lots of property companies and various things like that. So it's the first time I really sort of got involved in options were one of the things we came across, completing building projects, selling on properties. So it was a long time ago now, a bit of an introduction. After that, I moved to Orange, a telecoms company. So they don't exist in the UK anymore. But at the time, I was in a part of the finance team, so building spreadsheet models. And one of the main things we achieved was forecasting how much a 3G license would be worth, how much Orange should pay for a 3G license. So it was 4.6 billion. And at the time, they didn't really know what they were going to do with it. But the main obstacle or the main challenge was to keep other competitors out of the market. So it was really the opportunity cost of, or the lost opportunity cost of not having a 4G license. After that, I'd moved to, I could only take 2 years working with spreadsheets constantly, 8 hours a day. So moved to another telecoms company, which unfortunately didn't last too well. The company invented a new technology, didn't really sell in the market, then it went out of business. So I spent a year or so not working. By that time, I had a small property portfolio. Thought, what do I know about? I know about numbers, I know about property, and it's really how can I combine the two? With my portfolio, I'd seen a number of mortgage brokers and thought, well, I'm not really impressed by the brokers I've seen. So I learned to become a mortgage broker. So started working for Abbott's estate agents through their sort of countrywide mortgage broker arm. I lasted 11 months in the company. Really didn't like the ethics of the business, the culture. Within those 11 months, I was in the top 5 consultants within the region. Had a big argument with my boss and decided I was leaving, so left. Did a couple of small contracts for Norwich Union at the time, who are now Aviva. And my plan was to learn how to be a mortgage broker with Abbott's and then set up my own company. So I intended to stay there for 2 years, couldn't cope with it for more than 11 or 12 months. Had a couple of contracts, like I say, with Aviva. And when that was about to be renewed, thought, well, this isn't really what I want to be doing. I want to set up my own business and set up Shire Financial Services back in 2006. So the aim of that was really to provide a better service to my clients, to actually understand their needs, see what was important to them, and knowing the market, knowing about finance, to offer them some real advice. I've also been a landlord since 1999 when I bought my first property. So quite a long history with working with numbers, with finance, not really doing presentations. So as I say, started as an accidental landlord back in 1999. So an accidental landlord is a term that's really only came about within the last 3 years or so. So it's someone that bought their first property without the intention of doing it as a buy-to-let. So if you've inherited a property, if you've bought a property, then turn it into a buy-to-let after you've lived in it. In the regulations now, you're classed as an accidental landlord. And at the moment, that means you have greater protection under the FCA regulations. So it's a regulated mortgage, whereas most buy-to-lets aren't regulated, but as an accidental landlord, you've got the protection of the FCA and the Financial Services Compensation Scheme. I've now got 9 properties. So I'm halfway through buying a 10th one at the moment. They're worth about 2.1 million and have about £1 million equity in the properties. So for me, the big thing is that portfolio has built up from having 2 properties back in 1999. One was mine, one was my now wife's property, and all of the investment to grow that portfolio has been driven from those 2 properties by refinancing them, buying additional properties, letting them. So all the time through, they've been making profits, making extra money that I've put back into buying more properties. So without really working for it, I've created £1 million worth of equity. We're currently getting rents of £8,000 per month. So that's before paying the mortgages. After the mortgages, we're still getting about sort of £5,000 a month profit. We've also completed 4 flips. So buying a property, refurbishing it, and then putting it back on the market and selling it. Generally, we look to make about £30,000 each time. And on the whole, they take about up to 2 months to refurbish and get it straight back on the market and sell the property as quickly as we can. So most of the time it's selling it within 6 months. And I know people say, oh, you can't sell a property within 6 months. Buyers can't get a mortgage on it. That's not true. You can get mortgages within 6 months. Also refurbished a property, refurbished a property and remortgaged it at market value, completing the deal in 4 months. So getting 80% of the new market value from that property within 4 months of buying it. And with that, that meant we left about £10,000 in the property, but the rent was £1,100 a month. So within a year, we'd recovered that £10,000 that we left in the property as well. So sort of as a mortgage advisor, I've got probably quite a lot of experience around the property side as well. So looking at the property market, it's seen a huge amount of changes over the last 3 months. So beginning of the year, end of last year, the market was sort of fairly quiet. Lots of concerns about Brexit and what was going to happen. Beginning of this year, a new government and lots of confidence around the new government demonstrated in the market. So house prices started to show an increase. Lots of buyers were coming back into the market. By the time we got to March, the market was actually really quite buoyant. However, then coronavirus hit and lenders started to pull out of the market. So yeah, as I say, about half of the other products were withdrawn. Now, 3 months later, most of the lenders are back in the market. It's not really back to where it was. I think before you could get up to 85% loan to value on a buy-to-let mortgage. Now it's really sort of 75% is where most of the market's sitting at. But most of the market are back in and lending at 75% loan to value. There's a few lenders at 80%, just for standard buy-to-let properties though. Yep, these ones, Land Bay, Ipswich, Virgin and Ecology. Ecology, I've never actually placed a mortgage with them, but they look for properties that are ecologically friendly, so very low emissions results, where you're maybe buying a property and renovating it and improving the EPC score by 2 grades or more. So they're a very niche lender, but that's probably why they're lending at 80% loan to value. Limited companies and HMOs, you're really looking at a maximum of 75% lending now. There's no lenders in the market up to 80% for those at the moment. And serviced accommodation. We've had a few clients looking for serviced accommodation or holiday lets, and fairly much as people haven't been allowed to go away and take holidays, the banks are thinking, well, why would we lend to someone who's buying a holiday let when there's no market for people to actually occupy that property? So at the moment, they're not in, but we're hoping that will change sort of fairly soon. So the current market, mortgage rates have dropped since the start of lockdown. So the Bank of England dropped rates twice, sort of very quickly. Lenders were very slow to react, and they didn't want to reduce their lending rates. And in fact, some of the mortgage lenders put rates up. So where they were backed mostly by American companies, Americans decided they didn't want to support the UK property market, and they were concerned about what was going to happen. So as the Bank of England were dropping base rates, lenders were putting rates up because the cost to them of borrowing money had jumped by about 0.3%. So it was a very sort of turbulent market at the beginning of lockdown. It's leveled out a bit now, and rates have sort of come back down recently. Accord, who are one of the sort of middle buy-to-let lenders, were saying that they've had their busiest 2 days of trading for 17 years. So the market has really picked up over sort of the last few weeks. Lots of people are out there, lots of investors are out there buying properties, lots of first-time buyers are out there, and people moving. So the whole market's been stuck for about 3 months, and finally the floodgates have opened. Estate agents have gone back to work. People are now able to start looking for properties and buying properties. TMW, one of the main buy-to-let lenders, they're taking 2 weeks to arrange a desktop valuation. So an AVM's an automated valuation model. So it's where the surveyors work on their computers, they look at Rightmove, they look at other property sites, they look at comparables, and come up with a valuation for the property. Sometimes they come back and say, oh, we need to see the property to decide what the value is going to be. And it's then about another 3 weeks before they actually do their valuation. So end of May, I applied for a mortgage with TMW on a new property I'm buying. It's a standard mid-terrace property, fairly large town. They decided that they need to do a physical valuation. So that's booked in for next Monday. That was after applying at the end of May for the mortgage. So it really slows down the process. So if you're looking at buying properties and you need to move quickly, it's going to be very hard. You've really got to make sure you're going with the right lenders, and it's a very standard property. On the other hand, HSBC, we completed a residential application, submitted it at 8:40 in the morning, and by 10 to 11 the same day, they'd done the valuation and it was back on the system. So some banks are very switched on, very automated. They can get valuations. So with HSBC, they wouldn't be having a person look at comparables. It would all be computer generated. And if it can run through their system, and other banks are doing this as well, if it goes straight through their system, you can get the valuations back really quickly and enable you to move on. Where a surveyor has to go out there, don't expect anything to happen too quickly. Mortgage holidays. I've had lots of people asking me about mortgage holidays. So when the government announced announced if you needed to have a payment holiday, you could have a 3-month payment holiday. The banks weren't ready for it. I was talking to some of the lenders and they were saying one day we were telling buy-to-let landlords, customers, they can't have a payment holiday. That night, the government announced anyone could have a payment holiday, and the next day they had to be in a position to let customers have payment holidays. So their systems weren't ready. They didn't have controls in place. So basically, if you contacted them asking for a payment holiday, they gave you a payment holiday. Lots of landlords took advantage of that and thinking it's a way to save money, maybe build up some extra money. We didn't know what was going to happen in the market. We didn't know whether our tenants would keep paying mortgages. So customers took those holidays. The banks found that I think it was getting on for a third of their payments were suddenly non-performing because customers had taken these payment holidays, which has a big impact on the banks. If they suddenly find that a third of their income's no longer happening, that's huge for them. So the banks have now sort of looked at it and they're saying, well, if you're now applying for a mortgage, if you've got a payment holiday at the moment, that means you can't afford to pay your mortgage. So why would we lend to you now when you can't pay, on another property when you can't pay the mortgages you've got on your existing properties. So on the whole, if you're currently in a payment holiday and it's a buy-to-let property, it's very hard to get a lender to lend to you. So it's a case of planning. If you're buying a property, if you've taken payment holidays, put them back onto performing loans, or have a very good reason as to why you need to have a payment holiday. So the government's announced that you can extend the payment holidays for a further 6 months, which is great if you're not a landlord. If it's your residential mortgage, if you've lost your job, then it's really valuable. But most of my clients, they found that their tenants are still paying. We've got, out of my 9 properties, we've got one tenant who's now a month behind, but he's claiming benefits and he's paying his mortgage he's paying his rent each month, and he's just 1 month behind. So it's not really causing us a problem, and most of my clients are in the same situation. So it's a problem for the lenders, and they're really making it our problem as well. They don't expect you to ask for payment holidays if you don't need them. Bounce back loans are the other thing. So if you're running a company, possibly even if you're running a business as a sole trader, you can apply for the bounce back loans. And again, when it was announced, people were applying. There were very few checks in place for that. It's completely self-certified. So if your business turns over, and it's based on turnover, not profit. So if your business turns over 200,000, you can apply for a £50,000 bounce back loan. And the banks weren't checking to see what your turnover really was, but they've changed that now, and they are verifying that you're actually telling the truth in your applications. So again, you need to be careful. Make sure you are being honest. So even though it's all self-certified, still very few checks in place, they are starting to look at that. Also, the banks won't allow you to use a bounce back loan as a deposit. So the bounce back loans are there to support your business, not to buy investment property. That's the line they're taking. So if you're thinking, I'm going to get £50,000 bounce back loan, use that to buy buy-to-let property, that's going to cause you a problem. And if the bank's asking for proof of deposit, which they should be, they're going to come back and say, no, we're not accepting that as a deposit. So, I mean, there are ways around that, how to sort of position the money. If you've already got money, you could use that instead of a bounce back loan. But they're not letting you use a bounce back loan as straight away as the deposit. First-time landlords. So most lenders are available for first-time landlords. So TMW, Birmingham Mid-Shires, all the other big lenders, if you're a first-time landlord, they're quite happy to lend to you. If you're buying a standard single-let buy-to-let property, if it's an HMO, then there's only really one lender in the market that will lend on first-time buyers buying an HMO, and that's Kent Reliance. They've been out of the market for quite some time, and they've come back into the market sort of over the last couple of weeks or so. So if you have to buy an HMO as your first property with no experience, good luck. But Kent Reliance will lend to you. Holiday lets and serviced accommodation, as I said already, there's very few lenders that will lend for serviced accommodation. Actually, sorry, going back to HMOs, if it's a small property, so if it's up to 4 rooms, then you may not need an HMO mortgage on it. People like Birmingham Mid-Shires, Kent Reliance, and a number of others will lend on up to 4 people sharing a property. So although it may now be a licensable property, you can still, in some cases, get a standard buy-to-let mortgage on it. Holiday lets and serviced accommodation, the market really isn't there for that at the moment because you've got no tenants to let the property to. So the banks aren't seeing why they should risk their money lending to you for a property that's not going to produce an income. I'm sure that will change as sort of lots of people are going to have staycations. They're not going abroad. They're not going to Spain. So I'm sure there will be a demand, and the lenders will open up to that again, sort of hopefully fairly soon once the market opens up. Limited companies. If you're a first-time landlord, limited companies are okay. There's a number of lenders who will lend to a first-time landlord buying via a limited company. You just need to make sure that a limited company is the right option for you, that's really how you want to structure your first buy-to-let purchase. So if you are buying in a limited company, then generally set up as a special purpose vehicle. So I've heard lots of people saying, I want to set up an SPV, but they don't realize an SPV is a limited company. It's a special kind of limited company. And what makes it special is that it only does one activity. And so that's buying property, buying and letting property, buying and selling property. So that's what an SPV is. It's a limited company, but it's just a special kind of limited company. With those, you can set them up today and you can buy a property with them straight away, as long as you have a bank account. So I've had, especially inexperienced landlords, ask me, how long do I need to have my company for? I don't have any accounts for it. The banks really don't mind. They prefer it to be a completely new, completely clean company when you're buying investment property in it. The loan is actually written on the directors, so it's not written on the company at all, or underwritten on the company. So they carry out very few checks, make sure the company is registered at Companies House, make sure the company has a bank account. But what they're really looking at is who are the directors, who are the shareholders in some cases, and they underwrite it based on you. So if you've got bad credit, bad debts, your company is not going to be able to borrow money. If you don't meet the lending criteria, so if you're too young, too old, then again, they're not going to lend to your company. If you've set it up in the wrong way, if you've not set it up as an SPV, so with an SPV, they want the directors to be the shareholders. So directors run a company, shareholders own the company. And in most small companies, they're the same people. So you can't distinguish between the two. But if you decide, I want to put a holding company in, so I don't actually own own my SPV, I'm a director of it, but my holding company actually owns the shares because you want to move the profits it makes into your trading company or a different company. A lot of the lenders don't like that, and they won't lend to a company set up in that way. One of the things with mortgages, there's always exceptions. So we can always find a lender that will lend to that, even one that will lend to a trading company. So, if your day job is, I don't know, erecting fences, and you're trading a company that runs erecting fences business, you can buy property in that company. But instead of having access to the whole limited company market, which is fairly small anyway, you've probably got access to 30% of the limited company market. So once you start limiting the size of the market, you put your costs up. So it's really worth thinking, if you're going to buy in a limited company, how you set that up. Talk to a mortgage broker. Don't just accept what your accountant tells you, because most accountants don't realize any of this stuff. Again, if you're buying through an SPV, the bank's going to want a personal guarantee. So normally with a personal guarantee, you need a separate firm of solicitors to give you advice over what your responsibilities are. So generally speaking, as a personal, so it's putting the bank in the same position as if they were lending to you. If your company defaults, the bank can come to you for payment of the outstanding debt. So the SPV doesn't really protect you from any debt or any real problems, certainly as far as the property lending goes, because the bank will ask for that personal guarantee. A solicitor could charge you several £100s for advising you on your responsibilities for giving that guarantee to your company. So again, there's lots of extra costs of buying through an SPV. SIC code. So these are the company industry codes, and there's generally 3 codes which you need to have on your SPV: 68100, 68209, 68320. So this is when you set up the company, you've got to say what the company does, and these are the codes you need to use. If you're using other codes, it's likely to cause problems. So if you're making notes and you're going to buy in a limited company, make a note of these numbers. And when the company is set up, this is what you need to use. And the number of times I've seen clients come to me, their accountant set up the company for them, and they've not used these codes. They've said maybe it's a development company, it's doing something else, but they're buying a property, they're not developing property. This is if you're going to buy a buy-to-let property, HMO, single let, holiday let in a limited company, it needs to have these SIC codes. Self-employed income. So it's quite a good time of year at the moment if you're buying a residential property or a buy-to-let, and the lender's looking at what your personal income is. So at the moment, they will use income from 2019 year end, or if you've done it and you don't need to file your tax returns until January 2021, but if you've done it early, you can choose which accounts you're using, which income you're presenting to the lender, the 2019 or the 2020. So if you've seen 2020 figures have dropped a bit, you may not want to present those figures to a lender. If 2020's income has gone up, then get your tax returns done. You can do them anytime after the 5th of April. So get your tax returns done and use those to support any mortgage applications. From around the 5th of October, most lenders will require the 2020 tax return figures. So you need to be thinking about it now and be ready to have them ready to be filed by the 5th of October. But it's just a great time at the moment because you get to choose if you're self-employed. If you're a sole trader, then lenders work off the net profits that you make. So that's generally the profits after tax. If it's a partnership, then they're looking at your share of the partnership profits. Sorry, if it's net profit from a sole trader, so it's a profit before tax, and the same for partnership profits, but it's only your share. So if it's a 50-50 partnership, they're looking at your 50% share of that partnership profit. Limited companies are a bit more complicated again. So very often the banks will look at salary and dividends. So generally they'd look at your tax calculations to get those figures. Some lenders will actually look at the company accounts and some will look at both. So the other option that some of the banks look at is salary and retained profit for the year. So where you've got a really good, well-performing company and you think, I don't want to take the money out of it, but I need to get a big mortgage, some of the lenders will look at how much money, how much profit the company's made. So if you're a 100% shareholder in that company, they will take all of the profit the company's made after tax, add back in your salary and use that for calculating how much money they would lend to you, especially on a residential property. Whereas if you've made £100,000 profit, but you've only taken £20,000 in dividends and you've got a £10,000 salary, so the lenders that look at salary and dividends will take the 20,000 dividend, 10,000 salary, and lend you based on 30,000 income. If you've made 100,000 profit after tax, they would lend you on the £100,000 profit plus your salary of 10,000. So they'd lend to you based on £110,000 of income. So in some cases, it can make a huge difference to how much money you can borrow. And generally what they're looking for is accounts. So your fully completed, filed, full set of accounts, or tax calculations and tax overview. So the tax calculation is the form that you submit to the Inland Revenue, which calculates how much profit you've made and how much tax you have to pay. Because your accountant can file that using their own software, the lenders want to see the tax overview as well, which is a very simple document. It comes off the Inland Revenue website and it tells you how much tax is owed that year and how much tax you've paid. So the reason I ask for that is because the amount of tax you owe should match exactly to the amount of tax on your tax calculation. So it's really just a check. The other way is an accountant certificate. So we send a form out to your accountant fills it in. The banks don't look for your accounts, they don't look for your tax calculations, they just trust what your accountant's telling them that you've actually earned for that year. So buy-to-let stress calculations. So when banks lend to you on a buy-to-let, there's a fairly basic calculation that they use to decide how much you can borrow against a rental income. So that's the mortgage amount times 5.5% times 1.45, which is a stress rate, divided by 12, and that equals the monthly rent. So if the monthly rent equals that figure, then they will lend to you. So the 5.5 is a figure that's been set out by the government probably a couple of years ago now. So all of the banks, if you're borrowing on a mortgage product of less than 5 years, have to use a 5.5 calculation. So it's quite restrictive. So as an example, you're buying for 200,000, purchase at 75% loan to value, so you need a mortgage for 150,000. So 150,000 times 5.5% times 1.45 divided by 12 gives you a rental you need of £997 a month. So that's the basic calculation. However, lenders aren't all the same. They like to make things tricky. Every lender likes to put a slightly different spin on what they can do. So if you're buying over a 5-year deal, then instead of using the 5.5% as a notional interest rate, they can use 5%. And if you're basing it on 5%, then you only need to get a rent of £906 per year instead of £997. The other thing that they can do is, if you're buying through a limited company, instead of using a stress rate of 1.45, they often use a stress rate of 1.25. And if you're a lower rate taxpayer, some lenders will use 1.25 as well. So on a 2-year deal, that means you only need a rent of £859. And if it's on a 5-year deal, you only need rent of £781 per month. So there's so many variations. Lots of numbers, but as I've spent 2 years building spreadsheets, I'm quite used to numbers. The other option, if you're really pushing to get a 75% mortgage or a larger mortgage, where you have a 5-year deal, some of the lenders will lend based on the rate they're actually charging you. So if they were charging you a 3.6% rate and you're having it over 5 years or buying in a limited company, so you'd use 3.6% here, multiply that by 1.25, you could actually borrow 150,000 with as little as £563 a month rent. So again, these are lots of calculations. I've just run through a few of the basic ones. I think when I've looked at this, there's more than 20, 25 different calculations that the banks use. So again, if you're really trying to maximize how much money you can borrow for a small amount of rent, you need to talk to a mortgage broker to actually help you work that out. There's also top slicing, which I won't even go into, but it's really using your surplus earned income to help support the mortgage, the buy-to-let mortgage. So there's lots of things to push out how much rent you need, or how much rent you need to borrow a certain amount of money. In sort of the north of England, it's not a problem. In the southeast, it's a real problem, making the rents high enough to actually get the mortgage you want. Okay, so in case you hadn't had enough numbers yet, I thought I'd have a look at limited company versus personal mortgages. And so many new clients I see these days come to me saying, I've been told I need to buy in a limited company. I'm starting my property journey, and the government are not letting you offset any mortgage interest. So I've been told I've got to buy in a limited company. And ask them why, they say, I don't really know, but that's what I've been told. So what I've done here is to look at a simple comparison of buying a property for £200,000 in a limited company, in a personal mortgage, standard mortgage application for a single let property, and in your personal name as an HMO. So in all cases, 75% mortgage, so you're borrowing £150,000. And then I've done this, it was before lockdown, but I've looked at the best property deals for each of these. So in a limited company, I've lost my cursor. In a limited company, 2.79%. Buying in your personal name is 1.65%. And the HMO was actually, it was the same product as buying in a limited company. So it was the same rate. So that lender would lend to you either in your own name or in a limited company at the same interest rates. So the monthly interest obviously is lower if you're buying in a personal name. So you're saving over £100 per month on mortgage interest by buying it in your personal name as opposed to a limited company. If it's an HMO, it's not really making very much difference. So with these products, you've got arrangement fees. Again, the personal one is slightly higher in this case at 1,245, and the limited company and HMO are the same. So over 2 years, as you can see, you're paying between the mortgage costs and the interest, you're paying over £3,000 more in costs if you're buying in a limited company as against personal. And if you're buying an HMO, your mortgage costs are £3,000 higher than if you were buying a single let property. So most people, when they're buying HMOs, don't really factor in the extra interest cost. They're just saying, I get more rent, I can let out 5 rooms, I'm going to get £2,000 a month rent instead of £1,200 a month rent. But you've got to consider you're getting your much higher mortgage interest payments. So when you're planning what to do, you need to calculate all of these and look at these factors. So assuming with these you're getting £1,000 a month rent for each one, so you've got £12,000 a month income. Maintenance, let's say it's 10%, so 1,200 a year. Income after maintenance, same all the way across, £10,800. But the interest costs are much higher for the limited company and the personal company, and sort of almost half the figure really for personal. But then looking at taxable income. So if you're buying in a limited company, you can offset the mortgage interest, you can offset the maintenance. So your taxable income is only 6,615. Whereas if you're buying in your personal name, your taxable income is 10,800 because you can't offset the mortgage interest. So you've got a much higher taxable income figure. When you look at that, so we've brought forward the taxable income figures. With corporation tax, you're paying 19% corporation tax. So over the year, you're paying £1,257 in corporation tax. For personal customers, it's slightly different because you've got lower rate and higher rate taxpayers, so 20% and 40% taxpayers. So the tax that you pay, obviously 2,160 and 4,320. But what a lot of people forget is that you get the 20% tax credit back on the mortgage interest. So where you're paying a lower amount of mortgage interest, in the personal one, you get £495 tax credit back. And in the HMO, because the interest cost is so much higher, you're getting £837 tax credit back. So that means the corporation tax payable, if you're a basic rate taxpayer, 1665, high rate taxpayer, 3,825, then similar figures sort of for the HMO. So you can see you're paying a lot higher tax having it in your personal name than you are if you're buying in a limited company. And this is a reason that a lot of advisors say buy in a limited company because you're going to reduce your tax bill. So it's true, you will reduce your tax bill. But what they forget is how much money you actually take out. They don't factor in all the mortgage interest. They don't factor in the extra costs. So in a limited company, the company has made a profit of 5,358 in this example. If you want to take your profits out of the company, so you can take dividends, the first £2,000 of dividends you take out, there's no tax to pay. If you're a basic rate taxpayer, you pay 7.5% on the rest that you take out as dividends. So in this case, an extra £251 tax. Higher rate taxpayers, so if you're already earning whatever the higher rate limit is, £40,000, £50,000, you're going to be paying an extra £1,091 in tax. So when you look at it, the profit you're actually making through the limited company, if you've taken the money out of the limited company, it's 5,107 if you're a low rate taxpayer, or basic rate. If you're a high rate taxpayer, you're making 4,267. That against the profit you make if you're paying income tax. So personal, you're making £6,660. So assuming you get the same rent, you're actually making more money by buying the company in your personal name if you're a basic rate taxpayer, even once you've considered the disadvantage. Well, there's no disadvantage of the tax rules of Section 24 because you get the 20% tax credit back. Even if you're a high rate taxpayer in this example, you're still making £4,500 a year against the 4,267 as a high rate taxpayer taking the money out of the company in a limited company. And the HMOs have really got sort of the worst. If you're a high rate taxpayer, you're paying higher interest, you're paying more tax. So it's often better maybe in an HMO to buy it in a limited company. But certainly personal, if it's a single let property, because of the savings you're making in mortgage interest, you could actually be making more money by having the property in your personal name rather than a limited company. So this is clearly just one example. I'm not a tax advisor. I'm not giving sort of tax advice. I'm not recommending how you go ahead and do this, but these are the things that you need to consider, and these are the things you need to get your accountant to look at. So there are other reasons to buy in a limited company as well. Maybe succession planning. You could bring someone else in as a director or as a shareholder in the future. There may be other sort of tax advantages, but we haven't looked here. But purely because you can offset the mortgage interest in a limited company isn't always enough reason on its own to buy in a limited company. Whew, so that's quite heavy. Lots of numbers and talking about tax ranges. So I thought I'd have a few myth busters. So I've already mentioned this. First time buyer buying a buy-to-let. We've had 22 lenders saying they will lend to a first time buyer buying a buy-to-let property, including the main sort of banks out there, NatWest, Barclays, Leeds, Kensington. So these people will lend to you if you're a first time landlord and a first time buyer. What they will often look to see is, though, it's not as straightforward as it might sound, is if you are going to buy the property to live in yourself, do you have enough income to buy that property yourself as a residential property? If the answer is yes, then they will give you a buy-to-let mortgage, because the buy-to-let interest rates are higher than the residential interest rates. So they basically underwrite it on two bases. Can you afford to buy it as a residential property if you wanted to? If that's yes, does it stack up in the buy-to-let criteria? If that's yes, then the lenders will lend to you. The other thing is with some of the lenders, so people like Virgin, if you live in the southeast, you work in the southeast, your family's in the southeast, in London maybe, and you're buying in Liverpool or Manchester, they understand that the properties in the north of England have a much better yield than those in the south of England. So they're really saying, is it feasible for you to buy a property in Manchester if you're working in London? Is there a risk of you living in the property in Manchester, or are you clearly going to use it as a buy-to-let property? So if they conclude that you're clearly going to use it as a buy-to-let property, then they will very often lend to you if you don't own any other property on that one as a buy-to-let property, because they understand a little bit more about the investment strategies of people. Remortgaging within 6 months of buying a property. So there's more and more lenders now who will lend on day one. So if you buy a property for cash, buy a property with bridging finance, there's a number of lenders who will lend to you within 6 months. So 23 lenders, when I was checking, say they will lend to you within 6 months of buying a property. A lot of them will only lend at the purchase price. Some will lend at the purchase price plus the cost of works. So they will lend 75% of the purchase price plus 75% of the cost of works. Paragon will lend based on market value if it's a standard buy-to-let property. So Kent Reliance, Shorebrook, Interbay will probably lend on HMOs as well within 6 months based on market value. So again, you can get a mortgage on a property within 6 months of buying it. The 6-month rule has really come around because of anti-money laundering regulations. So yeah, so it's really there to stop people carrying out fraud. Let's try and get my mouse. Yep. First-time buyers buying an HMO. I've got 7 lenders who've said they will do that, but most of them are lenders who will lend to you for an HMO, but where it's not a proper HMO, where it's on a standard buy-to-let mortgage, but you're lending sort of you're letting it to 5 people or so. Kent Reliance will do up to 6 beds on a proper HMO. 100% mortgage. So Bath Building Society, if you've got a son or daughter going to university, they will lend to them 100% of the cost of the property they're going to live in while they're at university to the student. Has to be guaranteed by the parents, and they can let out rooms in that property to other students. So it's a really good way of getting your children on the property market. So I've got a few, I see my time's sort of rushing on. A few case studies. We've looked at or arranged to finance for a property in Leicester. So we've got, it's an unusual property. We've got the property here. Blue doesn't belong to my clients. They've got the whole top floor, the whole of this side, and the basement, which runs under both parts. So, and it's got 2 kitchens as well. So they've converted it into a 16-room HMO, 2 kitchens, valued about £1.4 million. So currently they've got development finance and a second charge financing. So they've financed 100% of the purchase price, the cost of development works, and they need 75% to get all of their money out. As I showed on the diagram, it's got a 15% flying freehold. So lots of lenders don't like property if they've got more than 15% flying freehold. It's near a city centre, which is great, but being near a city centre means it's near shops as well. And some lenders don't like it if you're trying to buy a property that's near shops. So Paragon are a prime example. 3 to 4 directors, they hadn't quite decided. One of the directors had a little bit of a dodgy financial credit history. So they weren't sure if they were going for 3 or 4 directors. They have limited HMO experience, so only one of them has a 5-bedroom HMO, but they've got other buy-to-let properties. So, as I said, Paragon didn't like it because it's a lovely property in quite a nice area near to a city centre, but they didn't like it and they were concerned about demand, they were concerned about shops. Property was too big for lenders like Land Bay, Vida Home Loans, Precise, Kent Reliant. So 16 rooms, they wouldn't lend that number of rooms. Aldermore would only do 70%. Shawbrook, who we'd approached, would do 75%, but at 4.65%. But Interbay, the one lender we went with in the end, would do 4.34% at 75% loan to value. This deal actually completed just after lockdown started. So we managed to squeeze it through. The lender started to become a bit concerned, and they were coming back asking more questions about how the mortgage would be funded if they couldn't let the property. We managed to answer all of those questions, and the case or the mortgage completed just after lockdown. And as the client had bridged all of the money in the deal before, paying about 1% per month, they were on sort of a 12% interest rate. So we really did well to knock that down to 4.34%. Just going back to that. So yeah, they've managed to get the property. It's about 75% let now, and it's covering its costs, and that's really going well. This was quite interesting. April 19 last year, had a referral from an accountant. The client was looking to raise a buy-to-let mortgage as a deposit to buy a property in Liverpool. Her current advisor was having trouble finding a lender who would lend to her because her income wasn't very consistent. She was also running syndicates for people buying into racehorses. We're based near Liverpool, near Newmarket, so there's quite a horse racing fraternity here. Say she worked part-time and had her own business. She'd found this new build flat in Liverpool, which she wanted to buy off plan. It'd been advertised that it was going to offer a 6.5 net per annum return guaranteed for 3 years, 15% discount for early investors, UK's #1 location for buy-to-lets. So these were headlines that were being publicised with the property. So for her living in Newmarket, sort of away from Liverpool, she knew Liverpool fairly well. So this sounds, really good. Guaranteed income, discount, great location for buy-to-let. So she was sold on the deal. So yeah, publicity for the property. It's looked sparkling pictures. This is actually the development, the 3 towers that were being built. So really good sort of artist impression of what was going on. Yeah, see reviews. It's a great property. Very spectacular design and look of the development. So the deal was she'd paid £5,000 reservation fee, £90,000 first instalment was due within 2 months. So this is what she saw us for, to raise £90,000 to pay for her first instalment. Then it was 90,000 on completion. So it's costing £185,000 for this flat. So we'd done some research. We could get the £90,000 at releasing money on her home. So she'd been up, viewed the site, they'd started work on it, there's hoardings up all around, basically a big hole in the ground where this tower block was going to be built. That all gave me concerns that the size of the property, I think there were 30 floors and 8 flats per floor, and she was being told this was going to be built within 12 months. So that sort of raised a few alarm bells with me, that I didn't really believe someone would build a skyscraper within 12 months. So on Companies House, I did a bit of digging and searched the company that was selling it, and they had one director who was aged 28, and you could see that he had 30 plus companies. There were no other board directors. So you're looking at someone that's building a multi-million-pound property complex, and he's got one director in the company that owns it, no other board directors, no finance director, no construction director. We looked at 5 sets of accounts for his other companies, and they were all showing losses on the balance sheet of multi-millions of pounds and huge liabilities. So the Evening Echo in Liverpool was saying that the director sort of started his property career 2 years ago. He's got 15 projects on the go, development of about £300 million, 2,500 full-time jobs in Liverpool he'd created from this one person. They were singing his praises. However, I'm sitting there with a client who wants to raise £90,000 on her house and thinking she's going to get into this debt to buy a property that's going to be complete in 12 months' time on a site that hasn't even started yet. So I'd sort of, it's not my job. I'm a mortgage advisor. If someone comes to me and tells me I want to get this mortgage, my job is to tell them what the best way is to get that mortgage. I'm not here to advise people whether they should invest in property or not. But I sort of went through some of this information I'd found out with her, and she decided it was probably the wrong thing to buy. So she went and asked for her £5,000 back and got the £5,000 back. So when I was looking at this a couple of days ago, just to sort of include it in the presentation, I found some articles from the Architects Journal in January this year saying that builders had stopped working on 2 Liverpool schemes. Lawless was the surname of a guy that was doing it, had been arrested on suspicion of fraud, along with someone from Liverpool Council. The Liverpool Echo in April this year said, and these are quotes from the papers, Elliot Lawless, owner of the Elliot Group, announced that the Infinity Towers, so the complex I've just shown you, scheme had been placed into administration. So from what my client had seen a year ago, all the glamorous brochures and everything, seen the site, the local papers singing the praises of this development person, how much work he was bringing to Liverpool, what a great job he was doing. His companies have now gone into administration, or these 2 anyway. If she'd put her £90,000 in it, she would have probably lost her £90,000 a year ago and have an extra £90,000 debt on the house that she lives in. So it's just really important that when you're investing in property, especially if you're investing in new build, you have to do your due diligence. Look behind the glossy literature, look at what you're actually investing in. It also, in one of the press cuttings, said that all of the 1 and 2 bedroom flats in the development had been sold. So lots of people, there's probably sort of hundreds of people that have put in £90,000 or something similar into these developments, which still hadn't been completed, should have been completed some time ago, and they're not. And I don't think they were being forecast for completion for at least another 2 years. But the chances are those people would have lost their deposits. So a case that we're currently working on. So had a new client, 71 years old, wanted to buy a property for £900,000 down in Dorset. He'd left his job last year, so he currently had no income. Owned his current house worth about 800,000, got planning permission to build a 4-bedroomed house next door to it, and it has 2 acres of land at the back, which he then wants to build 10 houses on. So, and he's got a pension fund of around £900,000. So he's not poor. And he came to me saying, I've got planning permission, I've got this house with no mortgage on that's worth 900,000. I've got a pension fund worth sort of 900, so his house is worth 800. You must be able to get me a mortgage to buy the new house I want to buy for 900,000. But the banks only lend on income. They want to know about serviceability of a mortgage, not what assets you've got. So the plan I came up with was to get a buy-to-let mortgage on the new house because he wasn't going to move into it straight away. Equity release mortgage. So on his house he's living in, because he's 71, he could borrow 31 to 34% of the value of that house on an equity release mortgage. Maybe even look at using his pension by moving it into a SAS and then using a SAS to lend to the development company. With those, there's lots of complications around SASs. Then his development company could pay him a dividend, which he could then use as part of the deposit for buying the property. So that one's still a work in progress. So yeah, by the time he built the development, he'd then be able to pay all the money back to the lenders and to his pension scheme. So he wouldn't actually be drawing money out of his pension scheme, which was quite important to him. Finally, a look at lending rates. So at the moment, the lowest rates in the market for standard buy-to-lets, 1.49 for a 2-year deal with a £1,500 approximately arrangement fee. 5-year deal is 1.92 with a £2,000 fee. Limited companies, so as you can see, the limited company products are 1.25% or a bit more than that, higher than the standard buy-to-let products. Fees are a little bit low, but these are the lowest interest rates out there at the moment. HMOs are even higher than the limited company rates. So lenders are at the moment a bit nervous about HMOs. There's more specialist lenders who lend to HMOs than to limited companies, and some of the specialist lenders are still finding funding a bit of a struggle. So they're not fully back in the market at the moment. Where I've coloured these green, it's where the rates have dropped within the last month, and where it's red, it's where they've gone up in the last month. So again, the HMO market's a bit more of a struggle for mortgages, but limited companies and buy-to-lets, there's more availability out there. So yeah, HMOs are the problem area until the lenders that specialise in that market come back in. So that was it for today. So I've got the wrong name on the end of this. I'll stop sharing my screen and go back to Amira. So Amira, are you there?
She should put the camera back on, please.
Yes, I'm just working on that.
Thank you very much for a very strong presentation. It was very interesting to see that limited company, personal, and HMO, that comparison. Thank you very much for taking the time to show us, because I don't think you're very right. You know, they don't look at from the whole picture, and it was really interesting to see it with complete view of a property developer, a property person, and very, very interesting. Yeah, it was Ashley. Thanks, Philip. So Ashley has a question. How do lenders currently view self-employed people who make their entire income from property?
Yeah, they're looking sort of closely at bank accounts, bank statements to make sure that they're paying their mortgages and that their tenants are paying as well. So they want to see what's happening. So they'd be asking for the most recent 3 months bank statements to make sure that everything's performing the way that it should do. If they've got big gaps, big arrears from rents not coming in, that could well cause problems.
Sure.
So they're looking at it from the bank statements.
Okay. Ashley, if that answered your question, yeah. So it's very interesting how there's so much information. Really, it's very interesting to see that those limited company mortgages have come down in this month, and in
Yes.
3 months service accommodation has been pulled back. However, we see how strongly it's growing right now. I mean, the markets are already picking up very strongly. So it would be a news every week. I think. I
Yes.
really appreciate the time that you have given, the detailed examples that you've provided. It was really, really valuable.
Yeah, I was looking at the example of the Liverpool property.
Yeah,
When I was looking at that this week, I really wasn't sure what I was going to find.
yeah,
And sort of having discouraged my client from buying in the property, I was
yeah,
kind of hoping I'd given her the right advice at the
yeah,
time.
yeah,
But it's just devastating for all those people that had invested in that
yeah,
property
yeah.
that hadn't
You know,
researched.
you're opening a very good point here. What's happening now? So what we have covered is we've been talking about development, permitted development, and now today we are talking about finance. The next event we are bringing John Corey, and he's talking about if you are a developer and if you are borrowing money from people, you have obligations in front of FCA from who you can borrow money. So it's very good that you raised that example where people been trying to lend to a project, but and it's the next event we are talking about. If you are a developer trying to borrow money from people, you need to understand that if something goes wrong, you will be held liable in front of FCA, and the person who has lent you the money would be protected under FCA. And I think it's very important because all of us work with investors, and it is important to understand what we need to be aware when we are raising funds for a project and how we need to do it correctly so that we as developers are protected and we have done the right things and the right notifications, right acknowledgements and right checks of those investors who would like to work with us, with the other people in the property development sector.
Yeah, I think with that, there's lots of things around high net worth investors and sophisticated investors, and certainly with a lot of crowdfunding platforms, they put lots of things in place to try and remove their liability from that. So they will only accept sophisticated investors and high net worth individuals actually putting money into deals because they're considered to have more ability to actually judge the investments themselves as well.
Sure.
But yeah, I'd certainly think as a developer, you have a huge obligation to the people that stand behind you and put their money into the deals.
Yes.
So,
and Ashley, please, Ashley, don't be, ask as many questions. We are here to answer your questions. So Ashley is saying it's regarding the 6 months rule. As like Philip said, estate agents have always said it's best to wait 6 months before selling a property, as the buyer won't be able to get a mortgage otherwise. Do you feel this is no longer the case, or that most lenders are now happy to lend within 6 months?
I think it was never the case, and the estate agents aren't very good most of the time. They really don't know what they're talking about. So several years ago, probably 2 or 3 years ago, we had a client buying a property from a builder. The builder bought the house, put it back on the market within about a month at double the value he bought it for. So he'd gone in, completely gutted it, refurbished the property and sold it for twice the price. We went to Nationwide and got the mortgage for them within a month of the builder buying it, doubling the price. And the mortgage went straight through without any problems. And that was a couple of years ago. So, it's not something new. It's just that estate agents on the whole aren't great. And and even the mortgage brokers that work in estate agents, you know, and that's where I started off. You don't know everything from their training. Countrywide are brilliant at providing training, but it's really sales training. It's not how to advise clients. It's not how to do the research. And they know the basics and they know how to tell a good story, but they don't know how to do the research, and they don't know how to solve the problems that clients have. And you know, there are so many lenders who will lend within 6 months of the property having been bought previously. But there are lenders who won't, like Halifax. Halifax won't, but there are lots of lenders who will, Nationwide, Santander. So you know, it's just having the right broker to find the right lenders for you.
It's very interesting how you say that it was the estate agent's misinformation which became tagged as 6 months rule, and it's another myth that you just
Yeah, I mean, there is a 6 month rule, but it doesn't apply to everybody. It doesn't. All lenders don't follow it, and a lot of the banks, because they have to comply with anti-money laundering regulations, it's quite easy for them to say, well, we won't lend to someone within 6 months. But generally, that's if you've bought the property and then you're looking at refinancing it, then there's less lenders who will lend to you within 6 months. But if you buy the property, you're quite open about, you know, who owned it before, how long they've owned it, and they're satisfied that there's nothing being hidden, most lenders are quite happy to lend to you. It's where they feel you're trying to deceive them or cover up information that they don't like it.
Yeah. If everyone has they are done with their questions, I will let Phil Game go. We have taken quite a lot of his evening. But Phil, thank you very much. I hope that we will have you up and running in Expo Booth area for the next event so that people can connect with you and get to know more about Shire Financial Services.
Yep, brilliant, thank you.
Regarding Interbay. Noel Watson is saying, good to have your confirmation regarding Interbay. They have offered us a 5-year fix at 4.4 on a 13-bed HMO 5-year.
Okay, one of the things to look out for with Interbay is that they have a lifetime early repayment penalty. So even though it's a 5-year deal, there will be a 1% early repayment charge for the whole term of the mortgage. Whereas most lenders, they stop it after the 5-year deal. But if you've got a 20-year mortgage for 20 years, you've got a 1% early repayment penalty. So just be aware of that. And what we did to get around it was to set the mortgage term to 5 years. So the deal is 5 years, the term of the mortgage is 5 years. So we just have to remortgage in 5 years' time, but then you avoid the 1% penalty.
Sure.
But yeah, you know, so hopefully your brokers pointed that out to you. But I think it's one of those things that's easy to miss because most lenders don't do it.
Yeah.
Don't do that.
Yeah. Thanks, Phil.
Okay.
Thank you. I'm sorry.
Yeah.
Out of interest, Phil, roughly what are development rates charged at? I know it depends on the project and the amount, but is it roughly 6%, 10%, etc.?
It's at the higher end. You're looking at probably 10 to 12% for development finance with arrangement fees. So probably 2% arrangement fee, but it does depend on experience, on what the deal is, on the value of the deal. And there are different lenders out there with slightly different rates, but you're normally looking at the higher end. And the loan to value. So if you're looking for the maximum, so 100% development finance, 60% land cost, it's going to be 10 to 12%. If you're putting in 50%, you could maybe get high street rates, which will be sort of nearer sort of 5% interest rate. So it depends on experience and LTV.
Okay. So Noel Watson, now you can see that, you know, there are always some points that some brokers may not, discuss and tell. It's always good to have a couple of options, you know. It's always good to discuss with different people to understand that little bit of information that is missing that final touch. So it's great that you all met with Phil Game. I hope that we will have his Expo booth up and running in the next events. But I'm gonna say goodbye to Phil. Thank you very much for your time. And hopefully I will be able to invite a lot of the people to the networking event, which we will have at least 15 minutes of. Thank you very much, Phil.
Okay, thank you.
Leave button, and have a great evening.
Okay, thanks a lot. Thanks, everybody.
Thank you. So, thank you very much, everyone, for today's participation. It was absolutely great. The next time we're talking about how to attract investor funds, how to qualify those people, the people who want to lend to you, how can you qualify and whether you can take their money. A lot of the time that is not discussed, that is not covered, and it's very important because you the person, the developer who's borrowing the funds, will hold the most of the liability in front of those people who have lent you. And it's very important to understand how can we qualify, how can we do the right thing so that we are not held accountable for everything if something goes wrong. Also, we're going to talk with so today it was a great event. We had Veronica to talk about our personal growth, and then we talked about mortgage market. Permitted development, you should watch out about permitted development. You should watch out the commercial projects in your area. This is going to be huge. You need to take advantage of this. You need to grow your network. You need to meet the right people. And if you're looking for investor finance, or if you're looking for joint ventures, just message me. Let's make 1 minute pitch about you. Let's put it out there. Let's get you connected to other people. Right now, I will leave the networking session on. It will be switched off, I think, in 10 minutes. That will still allow you to meet 3 or 4 people if you are going to be all participating. Okay, so I will meet you next time, the first Wednesday of the month, and that is going to be the 5th of August. Thank you very much for your participation today, and have a lovely evening. Goodbye.